We've all heard it said that history repeats itself. But in the stock market, investors perform some incredible mental gymnastics to convince themselves that this time it's different. The legendary investor Sir John Templeton, who averaged an insane 15% annual return for 38 straight years, once called those four words, "This time it's different," the most expensive in the English language. And he was absolutely right. Nothing destroys a brokerage account faster than blind optimism pretending to be financial genius. Jesse Livermore, a true pioneer of speculative trading, and the man who inspired the classic book Reminiscences of a Stock Operator, understood this perfectly. He was famous for making fortunes by shorting markets right before they crashed. Livermore said there's nothing new on Wall Street, because speculation is as old as the hills. Whatever happens in the stock market today has happened before, and it will definitely happen again. That insight brings us to a stock market bubble that's been largely forgotten, but one that looks disturbingly similar to what we're seeing right now. I'm talking about the Nifty 50 bubble of the early 1970s. Our story starts in the late 1960s. The United States had just enjoyed a massive 20-year economic boom after World War II. Factories were churning out goods. Suburbs were popping up everywhere, and Americans felt pretty much invincible. The country had won the war, landed a man on the moon, and it seemed like prosperity was guaranteed for everyone, forever. Between 1945 and 1970, the U.S. stock market skyrocketed, gaining over 350%. This fueled a wave of confidence and, you guessed it, blind optimism. It was in this environment that a new investment philosophy was born, known as one-decision stocks. The idea was shockingly simple: find companies that were so dominant, so powerful, that the only decision you ever had to make was to buy them. You would never, ever have to sell. These stocks became known as the Nifty 50, and these weren't some speculative startups run out of a garage. We're talking about blue-chip giants, household names like Coca-Cola, American Express, McDonald's, Disney, and Philip Morris. Investors were convinced that these companies were completely bulletproof. They believed their growth was unstoppable and their market positions were unshakable. But here's the thing: no investment, no matter how great the company, is immune to valuation. By the early 1970s, the Nifty 50 stocks weren't just expensive. They were priced as if the laws of financial gravity no longer applied. To put it in perspective, the overall stock market was trading at a reasonable price-to-earnings ratio, or P/E ratio, of about 15. That's a pretty standard historical average. But the Nifty 50 stocks were in a completely different universe. Coca-Cola was trading at 46 times its earnings. Xerox was at 49. McDonald's, the fast food king, was at a whopping 86 times earnings. And then there was Polaroid, the tech darling of its day, trading at an incredible 90 times earnings. The average for the whole Nifty 50 group was an astonishing 42 times earnings. At their out peak, these 50 stocks made up about 45% of the entire U.S. stock market's value. Think about that: just 50 companies held nearly half the market. And then, reality struck hard. Between 1973 and 1974, a perfect storm hit the global economy. Oil prices quadrupled due to the OPEC embargo. Inflation surged past 11%, unemployment doubled, and President Nixon shocked the world by ending the gold standard, severing the U.S. dollar's link to gold. The stock market completely collapsed, plunging by 50%. It was the worst bear market since the Great Depression, and those supposedly bulletproof, overvalued stocks, they weren't just corrected, they were utterly devastated. Coca-Cola, the eternal brand, fell over 60%. McDonald's dropped more than 70%. And Polaroid, the high-flying tech innovator, lost more than 90% of its value, effectively wiping out its shareholders. The pain wasn't short-lived either. Unlike the quick V-shaped recoveries we've gotten used to recently, the market took 8 long years, until 1981, just to get back to its previous highs. Investors who thought they were buying guaranteed eternal growth found themselves trapped in financial purgatory for nearly a decade. The one decision to buy turned into a decade-long nightmare of watching their investments go nowhere. So, why are we talking about a 50-year-old bubble today? Well, if you're an investor, you might be feeling a strong sense of déjà vu right now. The great Mark Twain famously said that history doesn't repeat itself, but it often rhymes. And what we're seeing today is rhyming loud and clear. Back in 1972, the Nifty 50 made up almost half the market. Fast forward to today, and we have the Magnificent Seven: Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia. Together, these seven gents now account for roughly 36% of the S&P 500. Once again, a tiny group of dominant companies is carrying the weight of the entire market on its shoulders. Now, don't get me wrong, these are undeniably innovative, industry-leading companies. They are changing the world, but you know what? So were Xerox and Polaroid in their time. Xerox was the undisputed king of copying, and Polaroid was the Apple of its day, a pioneer in instant photography. Great companies don't always make great investments, especially when you overpay for them. Today, investors are treating the Magnificent Seven like modern-day one-decision stocks. The valuations reflect this cult-like belief. Let's look at their P/E ratios. Google and Meta trade at around 28 times earnings. Amazon is at 35, Apple at 37, and Microsoft at 38. Then it gets even wilder. Nvidia, the leader of the AI revolution, is trading at 50 times earnings, and Tesla, the electric vehicle pioneer, is priced at an astronomical 247 times its earnings. These are incredible companies, no doubt. But they are also incredibly expensive, incredibly overconcentrated in portfolios and indexes, and they are worshipped as if they are completely immune to risk. Just like in 1972, investors are telling themselves the same comforting story. These companies are different. Their growth is limitless. Their moats are impenetrable. They will grow into their valuations, no matter how high they are. But all it takes is a few macroeconomic dominoes to fall: a spike in inflation, a geopolitical crisis, an unexpected recession for history to start rhyming once again. The higher the pedestal, the harder the fall. Warren Buffett summed it up perfectly when he said, "What we learn from history is that people don't learn from history." And so here we are again, half a century later, with investors whispering those same dangerous, expensive words. This time it's different. Thanks for watching. If you found this look at market history valuable, make sure to hit that like button and subscribe for more content. Let me know in the comments if you see the parallels, or if you think this time really is different. See you in the next video.